Are you interested in finance? Want to understand what's happening in Belgian corporate finance? Dreaming of breaking into investment banking, M&A, or private equity? Then The Finance Show is for you. Every 2 weeks, we break down the most important corporate finance news in Belgium and around the world. We bring you expert insights, career advice, and the stories behind the deals that shape our economy. Whether you're a student looking to break in, a professional staying sharp, or simply curious about the world of finance, this is your access point to Belgian corporate finance.
Hi everyone, and welcome back to The Finance Show, Belgium's podcast for corporate finance news, insight, and career guidance. Today, I'm joined by Jules. Jules, good to have you with me for the podcast today.
Hi Maxime, thank you very much for the second invitation. I'm really happy to be here, especially given the news from recent days, recent weeks. So I think it will be a really big episode today. So really happy to be here and to discuss this with you.
Before we dive in, a quick word on the Financial Tracker. So that's something we launched this week. The idea was quite simple. If you are looking for a finance internship or entry-level position in Belgium and in corporate finance, that might be the tool that could help you.
Yeah, I think it's a really valuable tool for the people that work, study, don't have too much time to scroll on social media, but also on work platforms. So be sure to check it out. I think it provides a really good overview of the whole job market.
Exactly. We have currently 45 listings in M&A, investment banking, private equity, and corporate development, even some consultancy job. It will be updated every week and it's completely free. You can have access to it on our website, so thefinanceshow.com, and then on the page tracker.
It's fair to say that this episode will be quite big. We had some trouble picking the right actuality as the market went a bit crazy, so we think our selection will be quite nice for you, so be sure to listen.
That's the least to say. On the public market, it was quite a crazy week, but on the negative side, with the geopolitical tension, everything was going down. But on the private market, actually, it was going crazy positive. Many deals were announced, many private equity, some IPOs are being announced, so it was really an interesting week indeed. Today we have 4 stories. The first one will be Keyrock, that just became Belgium's 9th unicorn after the closing of a Series C led by Standard Chartered. Then we have OpenUp, a Dutch employee mental health platform that raised 20 million euros with a well-known Belgian VC, Smartfin, that is leading the round. Third, we have Elia, Belgium's high-voltage grid operator, and they signed a 2 billion euros sustainability-linked revolving credit facility. So quite an interesting topic there as it is linked to sustainability metrics. And finally, we'll close our podcast with the global story. Today, it's SpaceX, which confidentially filed for what could be the largest IPO in history, targeting a valuation of $2 trillion.
There's actually a lot to cover. Maybe you can start with Keyrock and introducing the company and the deal.
Big Belgium story. Keyrock just raised $100 million in a Series C, and this is valuing the company at $1.1 billion, making it Belgium's 9th unicorn.
Yeah, so you just mentioned that there were 9 unicorns. On my behalf, I only know 3, so maybe we can start by having a look at all these 9.
Indeed, but maybe for the auditors, what are the 3 that you know?
Well, I know actually Odoo. I think most of the people will know them through the cars that we see driving on the way. Then I know also Aikido and Keyrock right now. But for the 6 others, you tell me.
As you say, Odoo, not only for the cars, but also for the open source ERP, Wallonia company valued at more than $9 billion today, and that became a unicorn in 2021. This is the most valuable Belgian tech company so far. Then we have Aikido, as you mentioned, quite recent as well. It's a cybersecurity company, and it became a unicorn in January 2026. Keyrock today, in March 2026. Then we also have Colibra, which is a data intelligence company based in Brussels. It became a unicorn in 2019. Team.blue, which is doing web hosting. It's based in Ghent, and it became a unicorn in 2022. Then we have Deliverect, restaurant tech, also based in Ghent. Then we have Kepler, which is doing commodities data, based in Brussels, and became a unicorn in 2023. Then Lighthouse Intelligence, again tech, but for hotel this time, became a unicorn in 2024. And finally, a recent one again, iCare, which is predictive maintenance, and it became a unicorn in December 2025.
So you mentioned Ghent a few times. What is actually the split between the regions?
For the first region, Flanders, we have 4 unicorns that arise from it. Team Blue, Deliverect, Lighthouse, and Aikido Security, all from Ghent. Then we have Brussels with Colibra, Kepler, and Keyrock. And finally, in Wallonia, we have Odoo and iCare. So you can see that the concentration in Flanders is really high, and that's something that we can see in the statistics as well. For all Belgium tech companies, 75% of them comes from Flanders, 13% from Wallonia, and 11% from Brussels.
If we go back no more to the company and the deal that happened, was this the first time they raised money?
Back to Keyrock, and no, this is not the first time they raised money. They have been at this since 2018. They had their seed at 900,000 euros, led by Volta Ventures, and this money helped them build product and get their first customers. In 2020, we have Series A. They raised 4.3 million euros, and it was led by 6 fintech ventures, Middle Game Ventures, and Volta Ventures again.
So at this point, the company was relatively small, right?
Yes, but then comes the real turning point. In 2022, they raised Series B, $72 million, so quite a step up, and this was led by Ripple, the well-known crypto company.
How do we explain such a massive jump, and especially in this type of period where there was actually the FTX scandal?
Good point. Indeed, they raised $72 million, but not in normal times. They did it right after the FTX collapse, which was a huge scandal, but they were able to do that because they proved the model worked at scale and they could really become profitable. Then finally, the last in date, Series C in 2026, a few days ago, and it's up to $100 million, which is led by Standard Chartered. And with all this money, along the years, they were able to acquire Turing Capital and Fidja Finance.
So you mentioned Series A, Series B, Series C. What is the difference between all these series, and why is it important to know the difference?
As you mentioned, the different seeds are for the different stage of the company maturity. You begin with pre-seed, which is a funding stage before seed, and it's the very first money the company raised from outside the funding team, typically from friends, family, angel investor, and microfunds. Then we have the seed. You're already at the ID stage. It's a small check, but high risk for the potential investor. You mainly bet on the vision and the team, not yet the products. Then comes Series A. You're working on a product, you have early customers and traction, and you're trying to prove the model is really working. This is typically between 2 and 10 million euros. Later on, you find Series B. The model is proven, you are scaling it, you want to go into more markets, you hire more people, and you develop your product further. This can be to tens of millions euros. Finally, the last in date for Keyrock, Series C. They were already a mature company, fast growing, maybe profitable already, and you could already be preparing for an IPO or more acquisition, and you raise from 50 to 2 million euros. Then the series goes on. You can raise Series D, Series E, etc. until you IPO or someone buy you out.
I think it's important to know the difference between all these different series. Why? Because it also entails that there's different type of investor. Some companies are specialized at investing in certain stage, so that's also important, right?
Yes, exactly. So you won't see a bank like Standard Chartered investing in seed. That's quite unusual. You will usually find smaller PE funds, such as we could find in our next story. But the fact that Standard Chartered is coming in at Series C makes a lot of sense. When the company is de-risked and the thesis is already proven, the model works, there is traction in the customers, that's when you see that kind of strategic capital come in.
I also want to clarify something because for years now banks have been against crypto with all it entails. So is it not weird to see that banks actually support this crypto company?
With a first look, it might seem a bit contradictory. A 160 years old British bank that puts money into a crypto firm. Banks have historically been the most skeptical voices on crypto, seeing it as volatile, risky, and a threat to their own business model. But that's exactly what makes this investment interesting. Standard Chartered Standard Chartered isn't investing despite being a bank. They're investing because they are one. They see crypto infrastructure and asset tokenization as the future of financial markets, and they want a seat at the table before that futures arrive. And those type of banks that take the opportunity of investing in crypto will be at the front of the technology revolution that we will see in the future.
They have just raised $100 million. Are they planning to do something special with this money? And if yes, what?
There are four main buckets they can use it for. The first one is balance sheet. It can be a bit boring, but it's regulatory. Under MiCA and equivalent European framework, you need minimum capital to operate. The bigger you get, the more money you must hold into your accounts.
So here it's not really about spending, it's more about regulatory buffer.
Exactly. This is the cost of being a legitimate institution, and that's what you have to do to follow the regulation in place in Europe. Then, the next one, we have geographic expansion. Keyrock is already present in Belgium, the UK, France, Switzerland, and the US since 2025. And next is likely Asia or the Middle East. So they could acquire other company or just expand into new markets. Third one is product development. They have launched an asset management product in 2025 with Options Desk Decentralized Finance, which was pushed via Fidja Finance, and there is more to come. And finally, as I mentioned, for geographic expansion, one idea could be acquisition. And the CEO explicitly said they want to participate in market consolidation. So that means they could acquire new companies in other markets they are not yet present in.
When you mention acquisition, what type of acquisition would actually make sense for such a company?
You could think of bolt-ons. Bolt-ons are smaller acquisitions made by a company to add a specific capability, product, or geographic presence. And they could acquire market makers in new geographies, DeFi infrastructure, asset managers with crypto exposure, or even algo trading firms to strengthen their tech.
One thing is quite challenging here. We explained that Keyrock managed to raise $100 million. However, when we look at the price of Bitcoin, it's actually going massively down. So how do we explain that they managed to raise so much funds?
As you mentioned, the crypto market is highly down. Bitcoin is currently around $67,000, nearly half of its all-time high a few months ago. But here is the key. Keyrock doesn't make money on Bitcoin or the whole market going up. They make money on the spread, the volume, and the market activity. And Jules, we have here a graph about the market volume of Bitcoin in the last few months. And we can see that volume-wise, the market is actually doing quite well. It's almost at its all-time high. The last few months were really down, but if we look at March and February, it's really, really high, and that's how they can still continue to make money. So for such a company, they don't depend only on the market going well, they depend on volatility of this market.
So with this, we close chapter 1 of our podcast and we open up chapter 2.
Next story, and this one has a Belgian angle too. Smartfin, the Brussels-based VC founded by Jurgen Ingels, just led a 20 million euro round into OpenUp. This is a Dutch employee mental health platform.
So 2 companies here involved in the deal. Can you introduce both of them?
Let's start with Smartfin. So it's a Belgium growth equity fund, over 600 million under management, and it focuses on B2B tech companies across Europe. Jurgen Ingels is the founder. He is a serial entrepreneur well known in the Belgium tech scene, and their portfolio includes companies such as Deliverect that we mentioned before as one of the Belgian unicorn.
And what about OpenUp?
OpenUp is an Amsterdam-based company founded in 2020 by Gijs Kopens, a registered psychologist. The company is using a B2B subscription model. The employers pay for their employee, and these employees get free, anonymous access to psychologists, lifestyle coaches, financial experts. There is no waiting list or no referral needed. The platform is available in 35 languages and have more than 2,000 corporate clients, including Rabobank, Decathlon, and PwC. In total, 600,000 employees and their family have access to the platform, and they're currently operating in the Netherlands, Germany, UK, France, and Belgium.
However, Smartfin is not the only company involved in this 20 million deal, right?
You're correct. Rubio Impact Venture, a Dutch impact VC, also co-invested. They actually led the previous round in 2022, and the total funding is now around 35 million euros.
We have previously mentioned the different stages a company goes through. Where are we here now for the OpenUp company? The fact that Smartfin is now investing in the company tells us something more?
That's a strong argument, yes. And here are a few signals. As mentioned, 2,000 plus paying corporate clients. That's not just a pilot platform, it's a proven market and business model. Quite big clients, as we mentioned, a few big corporates. They're operating in already 5 countries. And finally, Rubio invested in 2022, but is now reinvesting. They have seen the numbers from the inside and still think that it's worth investing in the companies. This deal looks like a Series B for OpenUp. Rubio led Series A in October 2022 with 15 million euros, and now the Series B at 20 led by Smartfin. The fact that they raised a B series means investors believe the model is proven, and the question now is purely execution. How fast can they expand in Europe and even outside of Europe?
You explained that we are already in a Series B, so does this mean that there is zero risk left in the model?
Not zero. There is never zero risk, especially in startups. The service components adds complexity. You depend on the quality of 250 professionals, and mental health is quite sensitive. One bad experience could damage the trust. But commercial risk is now much more dominant than product risk. The product works, the question is, how can they fuel growth?
The fact that Smartfin has invested in the company, does it signal something specific to the market?
It really means something. Smartfin is really selective. This is a 600 million euro fund, B2B tech focus with a strong track record. They don't do many deals per year, but when they lead a round, it means they have actually done a serious due diligence. And therefore, we can conclude that they're really convinced by OpenUp model.
We also explained that Rubio reinvested in the company. What information does this provide to the market?
Great question, and it's a bit more nuanced than it looks. The positive read is that Rubio has been inside the company since 2022. They have seen the real numbers, the team under pressure, and the growth trajectory. When an existing investor puts more money, that's informed conviction. It's not a blind bet.
And what would be the other side of the read?
It can also be a more defensive move. Here is the concept. When a new round happens, new investors come in, usually at a higher valuation. That means existing shareholders get diluted and their percentage of the company goes down. And when you're invested in the company since a long time, you don't really like that. So sometimes they reinvest, not because they're hugely excited, but more to protect their ownership percentage. That's called a pro rata right, the right to participate in future rounds to avoid dilution.
And we know that there are also other mechanisms for that.
There are many anti-dilution tools which protect investor if a future round happens at a lower valuation, what's called a down round. The most aggressive version is the full ratchet. If the company raises at a lower price than you paid, your share counts get adjusted upward to compensate you fully. The more common version is a weighted average anti-dilution, which is less punishing for the company, but still protects the investor.
What can thus be your final read about Rubio?
Honestly, probably both. The impact thesis is real. Rubio ties 100% of its compensation to impact outcomes, so they're not reinvesting just to avoid dilution. But the pro rata logic also applies. The honest answer is that you cannot know for sure from the outside. What matters is that a new independent investor, Smartfin, led the round. That's the cleanest signal of a genuine confidence in OpenUp.
It would also be interesting to talk about the valuation of such a company. Of course, because it's private, we don't have a lot of numbers, but how would you go with that?
There are 3 main candidates here. The first one is user growth, then we have recurring revenue, and finally client quality. Let's go through each of them. So for user growth, we have 600,000 employees with access to the platform, but that's not quite the right number. What matters is active user, as engagement rate on mental health platform can be really low. So you would want to know what percentage of employees actively use it and how often. That's the real retention signal. The second one is recurring revenue. This is the strongest metric for this business. It's a B2B subscription, employers pay it annually, and that makes revenue highly predictable. which helps with valuation with a DCF, for example. You would look at ARR, annual recurring revenue, and NRR, net recurring retention, meaning do clients expand their contact over time or cancel?
You mentioned these two metrics. What about the client quality?
This is critical here. Rabobank, Decathlon, PwC are all anchor clients. Those aren't going to cancel easily. Enterprise contracts are long, switching cost is high, and these companies care about their employer brand. A strong enterprise client base de-risks the revenue significantly.
So on their note, on the website, they mentioned that they will use this money to create a buy and build strategy. What do they actually mean by this?
That's a good question, but maybe first let's look at the two types of growth. The first one is organic growth. You grow by selling more of your existing products to new clients and in new markets. You hire a sales team in other countries, sign new corporate clients. This is slower but cleaner, no integration risk. And the second one is acquisition. You buy a company that's already operating in a market or has a capability you don't. This is faster entry, but integration is hard and expensive.
Okay, so I understand the theory, but why in the case of OpenUp would they want to do so?
A few reasons. First, Europe is fragmented. Mental health platforms vary enormously by country. Local players often have relationships with employers and regulators that take years to build. Buying them is faster than building it from scratch. Second, you might acquire capabilities, a platform with a stronger AI layer or specialization in a specific area like financial well-being or sleep. And third, it consolidates the market. If you buy competitors, you reduce the fragmentation and strengthen your pricing power.
With this said, this closes chapter 2. We now go on to chapter 3 with Elia.
Third story, and this one is a different type of deal. No startup, no raising funds. We're talking about Elia, the operators of Belgium high voltage electricity grids, and the company just signed a 2 billion euros revolving credit facility with a consortium of 8 banks.
2 billion? That's quite a big number.
It is, and it comes with a sustainability angle. The pricing is linked to ESG performance targets. We'll get into that later, but first, quick background about Elia. This is the Belgian transmission system operator. They own and manage the high voltage grids that move electricity across the country. It is not a startup, it is not a growth company, it's a regulated infrastructure business. They have stable and predictable cash flow, and the company is capital intensive.
In the introduction, you stated about RCF. What is actually an RCF?
A revolving credit facility, so an RCF, is like a credit card for companies. You have a credit limit, you draw what you need, you repay, and you can draw again. We covered the topic more in depth in episode 3 with Loop Earplug Story, so if you are interested or you want a deeper explanation, you can go back to this episode. But overall, this is fundamentally different from a term loan. A term loan gives you a fixed amount upfront and you repay over time. Once it's repaid, it's gone. An RCF is way more flexible. You borrow, you repay, and you can borrow again later.
And when you're a bank, how does the pricing actually work? What do you pay as a company?
There are 2 layers in the cost that you pay. The first one is the Euribor. It's the rate at which European banks lend to each other. Think of it as the floor. Everyone starts here. Today, the Euribor for 1 month is at 1.9% and the 3 months is at 2.1%. Then you have the spread. On top of the Euribor, you pay a margin. For a company like Elia, which is investment grade, regulated, and has stable cash flows, that spread is relatively low. We could think of 50 to 100 basis points, so 0.5 to 1%.
Hence, the total cost is roughly the Euribor plus the spread.
Exactly. So around 2% plus 0.5 to 1%, totaling 2.5 to 3%.
And so you only pay the interest on what you actually draw?
That is correct, and it's the key difference from a term loan. On the undrawn portion, you pay a commitment fee, much lower, so if you don't use it, you barely pay anything. An example, Elia has 2 billion euros available now. If they draw 500 million euros for 3 months, They pay Euribor plus the spread on the 500 only. On the remaining 1.5, they pay the commitment fee, then they repay and draw again as needed.
2 million feels quite big. Why such a big amount? Do they not want to pay a lower commitment fee?
They would probably want to lower this fee, but they won't draw everything at once, and that's exactly the point of an RCF. Elia is a regulated infrastructure company with massive capital expenditure plans. Belgium's energy transition, offshore wind connection, grid modernization, etc. The RCF is a liquidity backstop, not a spending plan. It's there in case they need it to bridge between bond issuance, cover seasonal cash needs, or even to react quickly to unexpected capex. So it's more about having the firepower available than actually deploying it all. You can think of it like a safety net. You might never fall, but you want it there in case of an emergency.
We already briefly explained how the pricing works. There are just two parameters, the Euribor and the spread. But what about the spread? How does a bank determine the spread?
It's based on a few key things. The first one is the credit quality of Elia. The company is investment grade and rated by one of the major agencies, and when you have a lower risk, it means you have a lower spread. A startup would pay 5 to 6% spread, while Elia pays a fraction of it. Then you have the tenor. This is a 5-year facility with 2 one-year extensions, so potentially 7 years. The longer the tenor, the more uncertainty there is, and therefore the slightly higher price you pay. Finally, the utilization expectation. Banks model how much of the facility they expect to actually be drawn. The more you draw, the more interest income they earn. And the less you draw, the more reliant on the commitment fee they have.
There's also another thing I want to clarify. They mention a syndicated loan. What is actually the meaning of this?
Syndication means the facility is shared across multiple banks rather than one bank taking the full risk. 2 billion is too large for one bank to hold comfortably on its balance sheet. So you form a consortium, each bank takes a slice.
You just explained that there are different banks involved in this deal. Do the banks have all the same role?
No, there is a hierarchy. ING is the coordinator. They ran the process, brought the banks together, structured the deal, and negotiated the terms with Elia. You can think of them as the lead arranger. Then you have BNP Paribas and Rabobank. They're the joint sustainability coordinators. They're responsible for structuring and validating the sustainability-linked components. Then comes KBC, is the agent, so they manage the mechanics, collects repayments, distribute the funds, and handles documentation between Elia and all 8 banks. The rest, ABN AMRO, Belfius, CACIB, and NatWest, they're participating banks. They take a share of the risk and earn their portion of the fees and interest.
There's also another parameter they mention on their website. They say that their loan is actually sustainable linked. What is this?
A sustainability-linked loan ties the pricing, so the spread, as we explained before, to ESG targets. If you hit the targets, the spread goes down. If you miss them, it goes up. Elia targets are about climate change, biodiversity, health, and safety. The money itself can be used for anything, general corporate purpose, and the ESG angle is only in the pricing.
Hence, it's basically a financial reward for good ESG behavior.
That's it for Elia. Hope you all learned something interesting with this sustainability-linked loan. And now we're moving on to the final news. This one is not Belgian, but it's a global news with the potential IPO of SpaceX. As you might know, SpaceX is Elon Musk's rocket and satellite company, and it has confidentially filed for an IPO that could be the largest in history.
We know that SpaceX is massive, but how large are we talking about?
The latest figures from Bloomberg, SpaceX is targeting a valuation of over $2 trillion and looking to raise up to $75 billion. To put that in context, the current record for the largest IPO ever is Saudi Aramco in 2019, 29 billion euros raised. SpaceX would be more than double that.
And what is SpaceX all about? Because we have this vision about rockets, but it entails much more than this, right?
Indeed, they have 3 main businesses. The first one is rocket launches. They dominate the orbital launch market. Then you have Starlink, the satellite internet, and it's currently the main cash generator for the company. And since February 2026, xAI, Elon Musk AI company, including Grok and X, formerly Twitter, after a merger a few weeks ago.
All right, but nothing is confirmed yet, right? It's only about rumors. So how close is SpaceX to an IPO?
They're pretty close. They have actually filed confidentially. And confidential filing is the first formal step. It gives the company time to finalize numbers and structure before going public.
You mentioned the first step. What are the next steps?
There are many steps they have to follow. The first one is public filing, so-called S1. The company publishes its full financial details, revenue, cost, risk structure, and everything for the first time. This is when the market gets a real look under the hood. Then you have the roadshow. The company and its banks travel to meet institutional investor, asset manager, pension funds. They pitch the story, check how big is the demand, and start building the order book. And then finally you have the first day of trading, during which shares go live on the exchange.
You mentioned that it was quite close to an IPO, but do we have an exact date of this happening?
We don't have an exact date yet, but Bloomberg points to June 2026 as a potential target. However, IPO timelines shift fast. It depends on the market conditions, regulatory review, investor appetite, and they can all have a big impact on the final date.
Besides the fact that it will be a record valuation, why is it also interesting?
As we mentioned, first there is the scale. $75 billion raised would be the largest IPO ever. That level of capital moving in a single transaction is extraordinary. Then you have the market signal. The IPO market has been relatively quiet for the past few years. A successful SpaceX listing at this scale would be signal that the window is open again. And this could trigger a wave of other IPOs. For example, OpenAI and Anthropic are both mentioned as potential followers.
The fact that SpaceX has merged with xAI in February is another important parameter.
Indeed, it matters for two reasons: valuation and narrative. First, the valuation. xAI includes both Grok, the AI assistant, and X, formerly Twitter. This adds an entirely new growth story to the SpaceX investment case. Investors pay higher multiple for AI companies than for aerospace companies. By integrating xAI, SpaceX can argue it deserves a tech AI valuation, not just a defense and aerospace one. What is interesting there is that SpaceX became the first AI integrated space company to list publicly. OpenAI and Anthropic, the two most talked about AI companies, are not yet public. If SpaceX lists first, it captures that investor appetite before anyone else.
This will thus allow SpaceX to obtain a first mover advantage.
Investors who want listed AI exposure today have limited options. NVIDIA exists for chips and a few others, but you don't have a pure AI player. SpaceX with xAI would give them something different. AI plus space infrastructure plus satellite internet, a unique combination.
The media also report dual class share structure. What is this exactly?
Most companies have one class of shares. One share, one vote, simple. A dual class share structure creates two categories of share with different voting rights. You have the Class A shares. This is sold to the public, typically one vote per share, and this is what retail and institutional investors buy in the IPO. But you also have Class B shares, held by the founders or insiders, typically 10 votes per share or sometimes more.
So even though the company is issuing extra shares, the founder keeps in control thanks to this mechanism.
Exactly. A classic example is Google. When Alphabet went public, the founders kept super voting shares. Meta did the same. Zuckerberg controls Meta despite owning a minority of the economic value. And this is the same logic for SpaceX. Musk will retain decision-making control over SpaceX even after the IPO.
In previous podcasts, as well as including this one, we have mentioned valuation. However, this company is complex. Is there a specific method that we can use to evaluate this company?
The answer is SOTP, sum of the parts. And it's a valuation method where instead of valuating a company as one single entity, you break it into individual businesses and you value each one separately. Once you have done that, you add them together. This method is used because different businesses deserve different valuation methods and different multiples. A satellite internet business is valued differently from a rocket launch business, which is valued differently from an AI company.
Can you give an example?
Sure. Imagine a company that owns a supermarket chain and a software startup. Obviously, very different. If you value it as one business, the high margin software growth drags up the multiples of the low margin supermarket, or vice versa. You get a blended number that doesn't really reflect either business accurately. SOTP helps you value the supermarket like a supermarket and the software like a software company. Then you add them up together.
Well, with this, I believe we can end chapter 4.
And that's a wrap on episode 4 as well. Jules, thanks for today.
Well, Maxime, thank you as well. And also thank you to the listeners that will take some time to listen to our podcast.
Today, we covered a lot. Keyrock and what Belgium 9th unicorn says about the local tech ecosystem, OpenUp and the mechanics of growth equity, and finally, for Belgian, Elia and a deep dive into debt financing and sustainable finance. For the global part, we covered SpaceX, probably the most anticipated IPO in market history right now. If you're a student, hopefully you are walking away with a few things that you can actually use in an interview, in class, or just to follow what's happening in the markets. Before you go, quick reminder on the Finance Show tracker. If you haven't signed up yet, head to thefinanceshow.com. Rather than going through LinkedIn post and company website every week looking for internship, everything is in one place. If you enjoyed the episode, a 5-star rating helps as well. One thing to know, you need to be on the show page itself, not the individual episode. Click the 3 dots and you will find it there. Finally, feedback, suggestions, questions are always welcome. Drop a comment or find us on LinkedIn. The link is on the show page. See you in 2 weeks for the next episode. Thanks for listening.